This is the part 3 of chapter number 8, term structure and volatility of interest rates. We have, if you remember, discussed 4 different theories of term structure. Pure expectation theory, liquidity preference theory, preferred habitat theory, and market segmentation theory. Unlike the market segmentation theory, the first 3 theories share a hypothesis that the behavior of short-term forward rates and also assume that the forward rates in current long-term bonds are closely related to market's expectation of about the future short-term rates. And that's why they are called collectively as expectations theories of the term structure of interest rate. What distinguishes these 3 expectation theories is whether there are systematic factors other than expectations of future interest rates that affect forward rates or not. Unlike the pure expectations theory, however, these 3 theories also differ in terms of the systemic factors, as I said, which other than the expectations. The pure expectations theory, if we talk about no systematic factors other than the expected future short-term rates affect forward rates. The liquidity preference theory and the preferred habitat theory on the other hand considers that there are other factors. So let's discuss each of these theories in details. So the pure expectations theory, it says that the entire term structure, according to this theory, the entire term structure at a given time reflects the market's current expectation of the family of future short-term rates. Under this view, the rising term structure must indicate that the market expects short-term rates to rise throughout the relevant future. So forward rates exclusively determine expected future spot rates. A rising term structure indicates market expectation about short-term interest rates to rise, a flattening to remain same, and a falling to decline. This theory, however, suffers from a few drawbacks. The drawbacks, those drawbacks are first, it ignores risk of investing in bonds. So if forward rates were perfect predictors of the future interest rates, then the future prices of bonds would be known with certainty. However, the return over any investment period would be certain and independent of maturity of the and therefore the return over any investment period would be certain, right? However, with the uncertainty about future interest rates and therefore about the future prices of the bond, these instruments become risky investment in the sense that the return over some investment horizon is unknown. 2 risks make this return uncertain. First, the price of the bond at the end of the investment horizon. So what we mean by the price of the bond at the end of the investment horizon. Let's take an example. Let's talk about 3 different alternative strategies. First is invest in a 5-year zero coupon bond and hold it for 5 years. So invest and hold a 5-year zero coupon bond, right? First alternative or the one investment strategy. Let's say the second is invest in a 12-year zero coupon bond and sell it at the end of 5 years. Invest in 12-year zero coupon bond and sell it at end of 5 years. And finally, the third strategy is let's say The third strategy is invest in a 30-year zero coupon bond and sell it at the end of 5 years. The return that will be realized in alternative 2 and 3 is not known because the price of each of these bonds at the end of 5 years is unknown. In the case of 12-year bond, the price will depend on the yield on 7-year bond 5 years from now, and the price of a 30-year bond will depend on the yield on 25-year bonds 5 years from now. Since the forward rates implied in the current term structure for a 7-year bond 5 years from now and a 5-year bond, 25-year bond 5 years from now are not perfect predictor of the actual future rates, there is uncertainty about the prices for both of these bonds. Thus, there is interest rate risk. That is, the price of the bond may be lower than the currently expected price over this investment horizon. The second risk involves the uncertainty about the rate at which you can invest again. So we are talking about the reinvestment risk. So let's now talk about again 3 different alternatives. Invest in a 5-year zero coupon bond for 5 years, right? And then invest 6-month zero coupon instrument, and when it matures, invest in 6-month zero coupon bill, and when it matures, reinvest on rolling basis for next 6 months until 5 years, right? Okay. And the third alternative is invest in a 2-year zero coupon bond, and when it matures, invest in a 3-year zero coupon bond. So invest in 2-year and then in a 3-year zero coupon bond, right? So when you analyze these 3 different strategies, the risk for alternative 2 and 3 is that the return over 5-year investment horizon is unknown because rates at which the proceeds can be invested until the end of investment horizon are unknown. So that's the problem here. So I hope you are clear about the risk is the pure expectation theory ignores the risk of investing in bonds, and the 2 kind of risk are: one is the price risk, which is basically the interest rate risk. There's the prices of the securities. If you invest in these 3 different alternatives will be different depending on interest rate, and other one is the reinvestment risk we have just discussed. So what is the basically interpretation of the pure expectation theory? So the interpretation is you have 3 different interpretations for this theory. Maybe 2 more broad, 2 main interpretation. One is the broadest interpretation, which says investor expect the return for any investment horizon to be same regardless of the maturity strategy selected. So this means that the so for example, consider an investor who has a 5-year investment horizon. According to this theory, it makes no difference if a 5-year, 12-year or 30-year bond is purchased and held for 5 years, since the investor expects the return from all 3 strategies to be the same. However, the major criticism and the thing we have just seen is that because the price risk associated with the investing in bonds with a maturity greater than the investment horizon, the expected returns from the two other alternatives we have just discussed here will not be the same as with the alternative one. The second one is the local expectations from the pure expectations theory. And it says that the return will be same over a short-term investment horizon starting today. So basically, this theory says this: if an investor has a 6-month investment horizon, buying a 1-year, 5-year, or 10-year bond will produce the same 6-month return. To illustrate this, let's use an hypothetical yield curve. So let's use this hypothetical yield curve. So you can see here is a time period, year, annual yield to maturity, price, and spot rate, bond equivalent basis spot rates. In chapter 6, we used these spot rates are constructed using the method we have discussed in chapter number 6. And here you can see that these are the 6-month forward rates calculated from these 20 spot rates, right? Again, these are calculated using the same methodology which we have discussed in our chapter number 6. What the local expectation theory asserts is that over the 6-month investment horizon, even the 5-year and 10-year issues will generate a total return of 3% if forward returns are realized. So if you let's say if you consider a 6-month sorry a 1-year bond, and let me talk about a 1-year bond, and let me put a data for a 1-year bond, and then let's talk about it. So let me put this data here. So if we talk about this 1-year bond whose coupon is 1.65, remember the spot the 1-year bonds annual yield is 3.3. Its price is selling at par, so the coupon is also 3.3. On the basis of this, it's 1.65. The cash flows occurring will be 101.65, right? 101.65. Now the question here is how much proceeds you will realize by the end of 6 months, right? So the price at horizon after the 6 months, the price will be 99.85265. Why the price have to be this is because the reason is that if the forward rates is realized, the 6 months yield 6 months from now will be 3.6%. Given a 6-month issue that must offer a yield of 3.6, the price of this issue will decline from 100 today to 99.85265 6 months from now, right? So the price will decline to 99.85265, right? So that this price must decline because the forward rate have to increase from 3.3 to 3.6, right? So the price will decline to this. What will be your proceeds? One, you are selling this security at 99.85269, plus you have also received a coupon of 1.65, right? So 99.85265 plus 1.65 gives you 101.5027. So these are your total proceeds. Remember, you have invested 100 because it was selling at par at the start. So your total return will be 3%, right? So by investing in a 1-year security, you can get a return of we can say the 3%. Now let's look at what will happen if you invest in a 5-year security. So let's see this data. So this is now a 5-year security. Let's go back and see that what are the 5-year securities annual yield. So 5-year securities annual yield is 5.2, which means that 6 monthly yield is 2.6, right? So cash flows of 2.6. The price of this security, so the price after getting first cash flow and remaining 4.5 years remaining, the price of this security will be 98.89954, plus you have also got 2.6 in the coping. So your total proceeds are 101.4995. Again, you have invested 100, and if you calculate the percentage change, 101.4995 minus 100 divided by 100, you will get 3%. So let me calculate these two here. So 101.5027 minus 100 and divide it by 100, right? So you will get 1.5%, and to annualize it, we will multiply it with 2, and you will get 3.00%, right? In the same way, if I calculate it here, it is 101.4995 minus 100 divided by 100, right? Because proceeds you have invested initially was 100, so you will again get 1.5%, and if you multiply it with 2, you will get annual rate of 3%, right? Now let's look at if you are investing in a 10-year security. So let's talk about a 10-year security. If you are investing in a 10-year security, again your process will be something like this. So again, if we see the 10-year security, its coupon should be 6% because it's selling at par, and its price for 19 time periods will be 98.50 plus 3 coupon if you add 101.5021, and again if you calculate the interest or the return, you will get 3% return, right? So this is what we are talking about. This is what I was talking about it. So the return for the short-term horizon starting today will be same, no matter what maturity security you are talking about, right? Okay. Now let's shift our attention and focus on forward rates and market consensus, the third interpretation of the theory. So, as per this interpretation, this theory says that we saw how to compute forward rate for any length of time beginning at any future date. So it is possible to compute a 2-year forward rate beginning 5 years from now, or 3-year forward rate beginning 8 years from now. We showed how using arbitrage arguments forward rates can be calculated. So as per this theory, this says that it is the forward rates are the break-even rate, the rate that will make an investor indifferent between investing for the full investment horizon and part of the investment horizon and rolling over the proceeds for the balance of the investment horizon. So let's say that the forward rate in our illustration was 6.2 can be interpreted as the break-even rate that will make an investment in 6 months. So let's say that we are talking about here the forward rates. Okay. So let's say we are talking about these two rates. Uh, 3.3 and 3, and then we are talking about this forward rate of 3.6. So 3.6, the forward rate 1 period from now for a 1 period shows that if you invest at a 3% today and 3.3% and 3.6% in the next period, it will be equivalent to if you are investing at 3.3%, right? So this is the logic we already discussed. A second interpretation of the forward rate is that it is the rate that allows the investor to lock the rate for some future period, right? So the forward rate allows us to lock the rate for some future period. And finally, one of the interpretation is proponents of the expectation theory argue that forward rates reflect the market consensus of the future interest rate. However, studies have demonstrated that forward rates do not do a good job at predicting future interest rates. Finally, let's talk about the two remaining theories. So the liquidity preference theory says the interest rate risk associated with the holding a bond for a 1 period is greater the longer the maturity of a bond. Recall the duration increases with the maturity. Giving this uncertainty, this theory suggests that the investor will hold long-term maturities if they are offered a long-term rate higher than the average of expected future rates by a risk premium that is positively related to term to maturity. Put differently, the forward rate should reflect both interest rate expectations and a liquidity premium, really a risk premium, and the premium should be higher for longer maturities. So, as per the liquidity theory, the second determinant is the liquidity premium. According to liquidity preference theory, forward rates will not be an unbiased estimate of the market expectation of future interest rates because they contain a liquidity premium. Finally, preferred habitat theory says that term structure reflects the expectation of the future path of interest rate as well as risk premium. So they reject assertion that the risk premium must increase with maturity. However, they say that given the balance between the supply and demand for funds within a given maturity range, investors and borrowers will not be reluctant to shift their investing and financing activities out of their preferred maturity sector to take advantage of this imbalance. So if there is an imbalance between different maturities, the investor and borrower may go out of their preferred sector. However, to do so or to induce them to do that, investor must be induced by yield premium in order to accept the risk associated with the shifting funds out of their preferred sector. Similarly, borrowers can only be induced to raise funds in a maturity other than their preferred sector by sufficient cost saving to compensate for corresponding funding risk. Thus, this theory proposes that the shape of the yield curve is determined by both expectations of future interest rates and risk premium, positive or negative, to induce market participants to shift off their preferred habitat. That's all about these theories. In our next video, we will be talking about measuring yield curve.